Ladies and gentlemen, good evening and welcome to the 20th Annual Hayek Memorial Lecture. As you all know, the Institute of Economic Affairs exists to educate people about the role that free markets can play in tackling the problems society face. And one of the key themes of the Institute's work this year has been the importance of governments being fiscally responsible and the need to bring about supply-side reform and tax reductions in order to encourage economic growth. Professor Barro's work in this area provides critical insights for the Institute, for the government here in the United Kingdom, but also for governments across the globe. And so it's my pleasure to introduce him tonight as our speaker for this year's Hayek Memorial Lecture. And I'm delighted that Hayek's family is represented here today by Esther Hayek, Professor Hayek's daughter-in-law. Professor Robert Barro is one of the world's leading economists and is perhaps especially well known for his pioneering work on how budget deficits and associated policies affect economic growth. He is the Paul M. Warburg Professor of Economics at Harvard University, a Senior Fellow of the Hoover Institution of Stanford University, and a Research Associate of the National Bureau of Economic Research. He has a PhD in economics from Harvard University and a BS in physics from Caltech. As well as this, he is the co-editor of Harvard's Quarterly Journal of Economics and was recently made president of the Western Economic Association and vice president of the American Economic Association. He is the honorary dean of the China Economics and Management Academy at the Central University of Beijing. He is also, of course, a prolific author and media contributor. He has written extensively on macroeconomics and economic growth, focusing in his research on the empirical determinants of economic growth, the economic effects of public debt and budget deficits, and the formation of monetary policy. His current research focuses on two very different topics: the interplay between religion and political economy, and the impact of rare disasters on assets markets. Although an economist by training, his work applies this discipline to many areas of life. The economic crisis has created an understandable desire for enhancing economic growth and perhaps an appetite even for greater economic literacy and numeracy. Different strategies are being deployed in different jurisdictions. On the other side of the Atlantic, we have seen very substantial fiscal stimulus packages. Here, since the formation of the coalition government last May, the UK has embarked on a modest programme of fiscal retrenchment. Indeed, last June, Professor Robert Skidelsky, a biographer of Keynes, said, "We are about to embark on a momentous experiment to discover which of the two stories about the economy is true. If, in fact, fiscal consolidation proves to be the royal road to recovery and fast growth, then we might as well bury Keynes once and for all." Professor Barro's lecture could not be on a more appropriate topic or come at a better time. To deliver the 20th Hayek Memorial Lecture, ladies and gentlemen, please join with me in welcoming Professor Robert Barro. Professor Barro.
Well, it's a great pleasure to be here. I certainly could not resist giving a lecture that's named after Hayek, not to mention following in the footsteps of my great friend Gary Becker, who I believe delivered the lecture last year. I wanted to talk about the perhaps ongoing recession, financial crisis, and as mentioned, some of it about the government responses in terms of fiscal stimulus packages and other matters. As a brief introduction, I think the central origin of the crisis, particularly in the United States, was from the housing market. And I'll try to detail why I think that's true, particularly housing in relation to the mortgage financing and the developments in that sector. I think there was a critical mistake made in terms of underestimating the possibility that housing prices could fall on average, because basically this was an unprecedented event, particularly in terms of the magnitude of the decline in average house prices in the U.S. And I think that was the precipitating agent for the crisis, both in the U.S. and elsewhere. And indeed, this aspect of house prices interacts with developments in the financial sector in terms of new products, securitizations, and so on. I think a number of mistakes were made here, but I think it's critical to realize that these mistakes have basically been learned, particularly by the financial sector. And it's unlikely that the next crisis is going to look like that. And then it's probably not the best source of policy change to try to fix the mistake that maybe caused the crisis but has already been learned. And indeed, I think the most likely next crisis is going to have to do with governments per se. And it's not going to be such a good thing if governments are going to try to keep the private sector from doing something to avoid the crisis that was perhaps what it looked like in 2008, 2009. So let me try to give some of the data. This will be from a US perspective, but I think a lot of it is global in nature. So this is just a picture of the Great Recession from the US perspective, measured in terms of the growth rate of the real gross domestic product. And I think you can see readily the recession in terms of the negative part. It cumulates to a decline in GDP by 4.1%. I don't know if that sounds impressive. It actually is the largest post-World War II decline, bigger than the other recessions, not by a lot, but a little bit bigger. It certainly does not measure up to the Great Depression of the 1930s. In this metric, it's not at all comparable. If you look at it relative to trend, then you can say there was a loss of 9% in GDP, which makes it look bigger, because normally the economy, the US economy, grows at about 3% per year. So if instead it was negative 4.1% for some period, that's a more substantial loss relative to the normal growth. The other thing that's been true, and has been particularly a concern recently, is the weakness of the recovery period, which is shown over here. So the average growth rate of GDP since the recovery began is less than 3% per year, which means it's not really a recovery in the sense of restoring something back to the trend. And this, I think, relates to why the labor market has been so weak. So it's been a very disappointing recovery, and in fact, it looks worse now than it did perhaps 6 months ago or so. By way of contrast, you can look at recoveries from some other recessions. So one is the Reagan period, basically the 1980s. It was a pretty substantial recession through 1982, but then the recovery is quite remarkable. For pretty much the rest of the 1980s going into 1990, the average growth rate in the recovery period is 4.3% per year. And I think a lot of this particular recovery is driven by tax policy changes. There are quite substantial reductions in marginal income tax rates in this period, early 1980s and again in 1986. This was something new, really, that Reagan had led, and I think it was quite an important factor in terms of the strength of the recovery. So an average growth rate well over 4.4% for this long a period is something impressive and very different from the current recovery. Another period you can look at is the 1990s. This is another strong period in the US. This is mostly when Clinton is president. So this follows the moderate recession around 1991. The average growth rate in this recovery is a little bit lower than Reagan. It's 3.6% per year, but it's a very extended recovery, basically almost all of the 1990s going into 2000. The two heroes in terms of post-World War II economic policy and results in the US, I think, are Reagan and Clinton, which shows you how nonpartisan I am in my approach to results. I think, at least in the way things turned out, Clinton turned out to be quite a conservative in terms of economic policy. And I think in that sense, he's kind of a twin with Reagan rather than being something different from that. This table just shows the global nature of the Great Recession. The US decline, I mentioned, was a little more than 4%, going up to the end of the recession in early 2009. The US is certainly not exceptional in terms of the severity. It's actually a little bit less than the average. For these 21 OECD countries, the extent of the GDP decline averages about 5.5%, somewhat more than the US. Several countries have declines of more than 10%, which is the metric I usually use to ascribe whether or not there's a rare macroeconomic disaster that has occurred. This is in a larger and longer term study. So some countries like Japan and Ireland and Finland, for example, are in that category. The decline was more than 10%. Greece would be in that category if you included all of 2010, which is not in this table. So several countries are more than 10% declines in GDP. Another indicator of the events is from financial markets, and this is specifically about stock market in the US. This is showing you the pattern of long-term returns on the stock market. And you can pick out the periods of major booms in the stock market and major collapses. And this was particularly important as a signal of what was going on in the worst of the Great Recession in the US, which is early 2009. And at that point, if you can see it at the end here, you can see where the bottom is. This looked very serious. And if you looked at what was the financial market predicting at that point, it was predicting a decline that was much worse than what turned out to be the case. Now, some people just denigrate the stock market as not being a very good forecasting tool, but in fact, it's better than almost anything you have available, even though certainly imperfect. So at the time, I wrote some column for the Wall Street Journal about what was the probability of the US getting into a depression type of scenario. And particularly based on the stock return information, I said that was something like 30%, which is enormously high. I remember talking to a reporter, and she said, "What do you mean the probability is 30%? Is it going to happen or isn't it?" And I find, at least in the US, you can't talk about probabilities when you talk to journalists. But anyway, that's what I thought was true at the time. So this was quite a serious threat, and from that perspective, things haven't worked out nearly as bad as they might have done. This is just showing you what are periods of major stock market booms and busts over the long term, going back to 1913. If you look at this table at the bottom, you can see the worst stock market bust is associated with the Great Depression. From 1929 to 1932, there's a decline in real value on the stock market by an amazing 79%. Very little of this is the crash in 1929 itself. It's actually the accumulation over 3 years that gives you that remarkable reduction. And the recent period is the second worst of that whole history. It's a decline in real value up till the beginning of March 2009, actually, of more than 50%. So it's actually the second worst stock market bust over this whole period. And I think that was a serious negative signal. And things have rebounded somewhat since then, but that was a serious crisis. This house price diagram, I think, suggests what may have been the major source of this downturn. So this is a series. The recent data are from the Case-Shiller price indices, which are very high-quality measures of house prices. So this is the real value of kind of average house prices in the United States. And you can see that there's this remarkable period of boom in house prices, average real prices going up by more than 80% in the period from 1997 to roughly 2006. And then there are a lot of reasons that have been put forward about why there was this amazing boom, and I'll talk about some of these possible factors. But the boom, of course, is followed by this equally amazing bust in house prices, something like 37% in terms of the average decline in real house prices in a period going up to, say, 2009. That really is an unprecedented shock from the standpoint of the US economy. And I think it's central that ex ante financial markets put zero probability weight on this kind of a result in terms of the house price decline. And I think that underlies a lot of the problems, including Lehman Brothers, but also other difficulties in the financial sector. It's also disturbing that actually there has not been a rebound of any significance, even up to today. It looked like there was some increase, but in the last months, house prices have actually fallen on average by another 7% or so. So there isn't really a rebound that you yet see in this metric. This is about commercial real estate prices. I won't go through this in any detail. The main result is that the cumulated decline associated with the Great Recession in commercial real estate is about the same, 30 to 40%, as in residential, but it clearly occurs later. It starts later. I think it's a reasonable inference that the problem started in the residential mortgage and housing sector and then spread elsewhere, including to commercial real estate. Part of what was propelling the boom and the bust, I think, is related to developments in securitization. This is showing you the securities related to residential mortgages. So this is the remarkable volume of issuance of these kinds of securities. So 2,400 means 2.4 trillion in 1 year in terms of securitizations. This is a remarkable number, in fact. And the red bars correspond to subprime and Alt-A mortgages. So I think a lot of the boom in the housing market had to do with the fact that there was a lot of cheap financing available to people who normally would not have been eligible for mortgages, that they were categorized as subprime, but partly propelled by the government and partly by reasoning in the financial markets that somehow you could make this into risk-free securities. So there was an incredible volume of subprime mortgages being securitized. Those are the red bars. There's two amazing inventions here, which if either of them were correct, they would have been one of the most remarkable things ever. So one is the idea that you can take a lot of garbage paper, subprime mortgages, but then you package it all together and you somehow diversify it all, and then the thing ends up being AAA, at least the upper tranches of this security. So you could create this vast amount of more or less risk-free paper by putting together a lot of junk. Now, if that were correct, that, of course, would be one of the most brilliant things ever. And people did have confidence in this for some period. But I think this doesn't work too well when the average prices of houses falls by 30 to 40%, as was true, as I indicated earlier. Alt-A is also a very interesting invention. You take people who don't normally qualify because they can't document their income, et cetera, but then you think these people otherwise are prime borrowers, so you call them Alt-A, and you basically provide mortgage financing on terms that are not too different from prime. That didn't work out too well either. In the end, Alt-A didn't perform all that differently from subprime in terms of defaults. So I think these are two sources of problems. These are other securitizations. I won't go through this. The U.S. government has had an amazing amount of involvement with the mortgage sector, different from that in other countries. So Congress, over many years, working through Fannie Mae and Freddie Mac especially, has particularly tried to expand the mortgage market so that basically everybody could own their own home. And this was the business of extending credit to people who didn't normally qualify. And the government-sponsored enterprises, Fannie Mae, Freddie Mac, were to a large extent the vehicle for this expansion. And of course, the reason that they went essentially bankrupt in September 2008 was because of the subprime and Alt-A products that they had amassed on their books. Even though they were supposedly not in that business, in fact, they amassed tremendous amounts of stuff which at some point was rated AAA, but was in fact really subprime and Alt-A kinds of mortgages. So I think the government involvement in the mortgage business in the United States is a crucial part of the picture. And I think going forward, it's important in the U.S. to phase out the government involvement in the mortgage sector, which means basically privatizing, eliminating these government-sponsored enterprises, Fannie Mae and Freddie Mac. The problem with that is that these vehicles are basically a creation of the Congress, and then the same people who were involved with creating these instruments and with expanding them are now in charge of re-regulating that industry. So it makes one a little bit not so optimistic about how the outcome is likely to be. So let me say some things about the U.S. response to the fiscal crisis. So of course there was a big midterm election, November 2010. which moved a lot away from the Democrat control and towards Republicans, particularly in the House of Representatives and somewhat in the U.S. Senate. I think part of what was going on in that period was that there was a general opposition to a lot of what the government had done in response to the crisis. So particularly a large amount of government expenditure in response to the recession starting 2008 while Bush was still president and going into 2009. So my view of this is different from that. I'm not just uniformly opposed to everything that the government did in response to the financial crisis. Maybe it's not consistent with Hayek, but I draw a big distinction between the financial bailouts versus the rest of the fiscal stimulus package and other interventions by the U.S. government. So if you go back to where the situation was in 2008, particularly when Lehman Brothers went bankrupt on September 15th, 2008, I thought we were in a really difficult situation that was threatening a Great Depression kind of outcome, as I described a little bit before. In that environment, I think it was true that some major financial institutions were too big to fail, in the sense that the cost to the economy and the taxpayers was too much to accept. And because of that, I thought it was a better outcome to have the government intervene as necessary to prevent those kinds of collapses. So that was the view of the government to some extent, except for letting Lehman go bankrupt in September of 2008, which I thought was a major mistake on the day it happened. And I think the U.S. government decided about 10 hours later or whatever that it was, in fact, a big error in terms of allowing that institution to go bankrupt. Overall, I think the financial bailout part, which is a bit less than $1 trillion in terms of what the government put into play, I thought that was unfortunate but necessary and wise under the circumstances. The rest of the fiscal expansion I thought was mostly a waste of money. So I draw a big distinction between those two pieces, but I think in terms of the U.S. electorate, I think there was opposition to all of it, that all of it was too much, which I think is actually mistaken. After Lehman, of course, there were a number of other larger interventions, AIG being probably the most important. So as I mentioned, after September 15th, the U.S. Treasury, Federal Reserve changed its viewpoint and decided it could no longer afford a bankruptcy of the type that Lehman had undergone, and therefore did everything it could to prevent further implosions of that type, which includes AIG, Morgan Stanley, Citibank, et cetera. So again, I think that was correct. I think it's very unfortunate from a moral hazard standpoint, but I think it really was a too big to fail situation in terms of where we had gotten to at the end of 2008. So let me talk about the fiscal stimulus package. Hayek could probably be more appreciative of my views on this part of the government intervention. So the U.S. fiscal stimulus package, this is 2009-2010, basically added up to something a bit less than $800 billion, which used to be a big number. I think this is mostly a waste of money. I don't think it's done a lot to retard the recession or to promote the economic recovery. I think the Obama administration is vastly overestimating the contribution of this package to the U.S. economic outcomes. Some of this comes down to your idea about what is the so-called spending multiplier. What is the effect on the real gross domestic product of the government spending an extra dollar, particularly increasing purchases of goods and services by $1? Government basically assumes that the spending multiplier is around 2. Now, if that were correct, that would be another remarkable, magical thing, sort of like the alt-A mortgages and the subprime stuff. If the multiplier is 2, it's quite amazing. It means that you can create something out of nothing. Just by spending another dollar, you not only get the dollar back, but you get another dollar. So even if what the government is spending on is totally wasteful, Keynes's example of digging holes and filling them up, that's public sector activity, it's nevertheless a good idea. So this is a remarkable vision about how the private economy operates, that somehow it's so inefficient that by doing this apparently foolish kind of intervention, you end up making things better. Now, I should say by way of confession that I used to be a Keynesian, and I did a lot of work in macroeconomics on Keynesian models, but I kind of got over it. And in terms of economic theory, and more particularly in terms of empirical evidence, I really don't think this is a good way of viewing how the macroeconomy operates. I've spent a lot of time on research recently trying to estimate what is the spending multiplier, or under what some circumstances, what is that? And there's some other research that other people have been doing that I think is increasingly informative about this kind of magnitude. As a rough estimate, I think that the spending multiplier is positive in the short run, which means that the GDP goes up, but not by as much as the amount that the government is spending. So a multiplier of about a half, I think, is roughly reasonable in terms of a one-year kind of response, a short-run type of response. Now, if you factor that into what the government did in 2009 and 2010, what you get is that the GDP growth rate in 2009 would have been higher by 1 percentage point than it would have been otherwise. So it is a positive contribution to GDP growth, but not that big, much smaller than what the administration has estimated. The effect the next year on growth is smaller because you've already kicked things up the first year and then you're sort of keeping it level. And then when you reduce the expenditure, because this is supposed to be a temporary program to stimulate the economy, then of course the effect becomes negative. That's 2011, when you're taking the thing back. The longer run effect is much more negative because of course you inflated the public debt by a very large amount, not only in the United States, but also in the UK and elsewhere. And ultimately you have to pay for that not by fiscal deficits, not by borrowing, but by raising taxes of some form. When you raise the taxes, you create a further negative effect on the economy because the taxes are distortionary. They tend to have negative incentive effects on things like investment and production. So other people have estimated what is the effect on the economy of an increase in taxes. And of course, in general, it depends on how you do it. But the ultimate answer, the overall answer, is that the effect is negative and larger in magnitude than the stimulus you got from the government expenditure. So I argued that the spending multiplier typically is around a half. The tax multiplier is clearly bigger than 1 in magnitude, but has a negative sign. So of course, if you put the two together, you get a so-called balanced budget multiplier, which Keynes also talked about. And since the tax effect is larger, the balanced budget multiplier is negative. And that's the sort of medium, longer run effect from this kind of fiscal stimulus thing. That's clearly negative in terms of economic growth. And we're moving into that part of this episode. I think the bottom line here is that the only reason you might want to spend $800 billion on public sector programs is if you think that those programs are really productive from a social return perspective, the sort of usual calculus that microeconomists would go through. So if you're thinking about building a highway, you figure out something about the social rate of return, and if it was high enough, maybe it's worth it. I think that's the right calculus as much during the recession as it is at any other time. And of course, that's not the reasoning that went into the stimulus package in the US and I think in other countries. I might just want to mention quickly, of course, it's the spending side of the Obama-type program. There's also some things that are called tax cuts as part of it. But in fact, until December of last year, the tax cuts weren't really tax rate cuts. They weren't things that gave people more incentives to do things like invest. They were basically throwing money at people, which is transfer payments. It's not really tax cuts. The December 2010 tax agreement was a bit different. This was forced on President Obama by the November elections. And he agreed in that package to keep intact the tax rate structure that had been put in place under Bush in 2003, and they introduced a cut in the Social Security payroll tax. So I have mixed feelings about that piece. It is a cut in a marginal tax rate, unlike all the rest of the things that were done. But on the other side, the Social Security payroll tax is actually the most efficient part of the revenue-raising scheme by the U.S. So if you're going to cut tax rates, that's probably not the favorite place to go. It's probably something way down the list of what would be an effective tax rate to cut. But at least it is a cut in a rate which is different from the other parts of the program. I think there is evidence, more detailed evidence than, of course, I can go through here, that cuts in marginal tax rates do have positive effects on economic growth. So I don't mean to seem like an extreme supply-sider with the view sometimes expressed from the 1980s that you can cut tax rates and you actually get more revenue. But I think it's definitely the case that if you cut marginal tax rates, you get a response in terms of more economic activity. And I have some quantitative estimates of that. And I think that worked particularly in the 1980s under Reagan, and to a lesser extent under the programs that the younger George Bush had, particularly in 2003. Okay, there's a series of other programs that the Obama administration has put into place that I think have been unfortunate. I think the bailout of General Motors was a mistake. I think General Motors, unlike Lehman Brothers, could very easily have been allowed to go bankrupt and be bought out by some other private companies. I don't think GM was too big to fail in the same sense that I think some major financial institutions are. And if we have time to talk about it, I can try to address why I think there's a difference there. The health care law, of course, is a problem. The most curious intervention of the government was the so-called Cash for Clunkers program. I don't know whether this program is well publicized in the UK, but this is one of the most idiotic programs ever designed by a government. I mean, you basically paid people to destroy functioning used cars and then give them a kind of a credit to buy new cars. And the consequence of that was that you destroyed some perfectly productive cars, and at the same time you changed the timing of when people bought automobiles, but it didn't do anything in terms of the longer run investment in terms of purchase of cars. This program, curiously enough, shows that incentives actually matter. But the incentives here were all perverse. But people did respond to those incentives. It's not like people ignored them. A more important mistake, which I find I get attacked viciously on if I ever mention it, is that the government made the unemployment insurance program much more generous than it used to be in the United States. So we had this well-functioning program of unemployment insurance, and I'm not really proposing to get rid of the whole program, but the basic idea was that the typical program was 26 weeks in duration, and then during recessions you raised the eligibility duration, typically from 26 weeks to about twice that length. That's what had been done several times, and it makes sense on economic grounds that the duration should be longer when there's a general recession going on rather than at other times. But what happened in the current situation, particularly in 2009, was that all of a sudden the eligibility was raised to 99 weeks, which is almost 4 times the normal. And I think that that program had some incentive effects that raised the unemployment rate, made it more persistently high, and more especially made the duration of unemployment much higher than it's ever been in the United States. But I find if I raise this point, I'm just described as not being a caring person, because I don't want to give more money to the poor, and the poor who are in particular unemployed. So I find it's very difficult to discuss this matter. Maybe here I can do it, but often it's difficult. I think it's also a problem for the United States that the Obama administration was preceded by the Bush administration, which was almost as bad. There was a tremendous expansion of government under Bush, and it really reversed the periods in the 1980s and the 1990s, which was Reagan and Clinton. And again, I was thinking of Reagan and Clinton as kind of being twins, but Obama and Bush are also kind of twins with respect to economic policy. So there's a list of problematic areas from Bush. One of the craziest ones being these ethanol subsidies, which you don't seem to be able to get rid of, even though the program, in this case, is not only idiotic like cash for clunkers, but it's much bigger. It's much more consequential, basically burning up half of the corn crop in order to inefficiently produce fuel. Shows you how hard it is to get rid of things once they're put into place. Let me say something about monetary policy, which I think is equally applicable to the UK as to the US, but I'll talk about the Federal Reserve in the United States. One part of the monetary policy was fairly conventional, but very substantial in magnitude, which was reducing nominal interest rates, short-term interest rates, in response to a severe recession. And I think that that was basically a reasonable policy. You can see it in the diagram. So this is the federal funds rate, which has been zero, roughly speaking, for some time now. And that's in response to the Great Recession. And I think that that was actually reasonable, and still reasonable to basically keep the rates at the low level that they're currently at. I don't know if I'm going to discuss it now, but this is the period that turned Greenspan from a hero into a villain. It used to be that Greenspan walked on water, and he could never do or say anything that anybody really criticized, no matter which political party. But this sharp reduction in interest rates here, apparently in response to the mild recession 2001, 2002, is very surprising. It's very surprising how sharply rates were cut here, and that's thought to be one of the factors underlying the housing boom, which I looked at before. But I won't dwell on that at the moment. The more surprising part, the quantitative easing part, which has become a favorite term recently, of the Fed is how much the balance sheet has expanded. So if you look at it since early 2008, before the crisis really hit, the balance sheet of the Federal Reserve has expanded by $2 trillion, which is a big amount of money. I mean, the GDP is $15 trillion. Roughly speaking. So $2 trillion is quite enormous, and it used to be less than $1 trillion, so that's tremendous proportionate expansion. Initially, which I found even more surprising at the time, the Federal Reserve expanded by buying up mortgage-backed securities, mostly, and they accumulated more than $1 trillion worth of mortgage-backed securities. So at that point, the Federal Reserve didn't look all that different from Lehman Brothers, as Lehman looked in late 2008. It has all this short-term financing in effect, and it's holding all these risky securities, which are particularly linked into the housing market. I didn't think this made any sense. It made the Federal Reserve look like a development bank. It was intervening in terms of which sector it was supporting. It was really threatening central bank independence because of these kinds of choices. It had a very risky portfolio. I didn't really understand this kind of a choice, and I think the Bank of England didn't do this kind of activity. So more recently, in the so-called QE2, the Fed did something more traditional in terms of buying up U.S. government securities. Another $800 billion, basically. They expanded the balance sheet, but this time buying treasury bonds rather than mortgage bonds. I don't think that there's much impact on the economy from this activity, and that would be equally true for the Bank of England as for the Federal Reserve. You have a situation where nominal interest rates short-term are essentially zero. And what the central bank is doing with these operations is it's putting on its books longer maturity stuff. I don't know what the average maturity is, but say it's like 5-year bonds, roughly on average. And then it's getting people to hold much shorter term stuff, which is reserves held on the books of the central bank, paying slightly positive but close to zero nominal interest, like U.S. Treasury bills now. So what that accomplishes is that if you look at what the private sector is holding, it's holding shorter term maturity stuff than it would have been otherwise. So instead of holding 5-year bonds, it's like overnight stuff. Well, first, I don't think that's going to matter very much. And secondly, the U.S. Treasury could have done that by itself without the central bank. If it wanted to fund the government by printing more Treasury bills, very short-term stuff, well, the Treasury can do that. It doesn't need the central bank. So basically, I don't think this is going to have very much impact. There's a question about whether this vast liquidity expansion is inflationary, because normally economists have thought that if you have these tremendous volume of open market operations, that it would be inflationary. The reason it's not inflationary in the current environment is that people or companies are willing to hold vast amounts of short-term paper at close to zero nominal interest because people still think that the economy is very risky, and they like stuff that looks secure even if it pays very low interest rates. So basically, the Federal Reserve can increase reserves by, say, $1 trillion and buy up $1 trillion of Treasury bonds. It's not inflationary because people are willing just to hold $1 trillion of extra reserves, and excess reserves on the books of the Fed have gone up by about $1.5 trillion over this relevant period. And people are just holding it. So as long as people are willing to do that, it doesn't have much effect on the real economy, but it's also not inflationary. So it sort of just doesn't matter that much. A difficulty with the strategy is it compromises the so-called exit strategy. In other words, if the economy eventually recovers and interest rates go up, then the Fed is going to have to reverse this whole process if it doesn't want to be inflationary. That's the so-called exit strategy. And the usual way to do that would be to sell off whatever the central bank had accumulated, whether it's mortgage securities or U.S. government bonds, sell that stuff off and correspondingly reduce the reserves or the high-powered money. And the problem with that is supposed to be, well, that might be contractionary. So there's a risk that you'll reignite a recession if you do that, but if you don't do it, it's going to be inflationary. That's supposed to be the problem. I think Bernanke in the U.S. is too confident about how he can handle this. I mean, he's certainly well aware of this problem. I think he's too confident about being able to handle this. So I would have thought it would be a serious threat. On the other hand, I always think financial markets know more than I do. And if you look at bonds, U.S. government bonds, both index bonds and nominal bonds, there's no high expectation of inflation even going out 10 years in that market. Expected inflation is something like 2%, maybe 2.5% if you look over 5 years, 10 years. So the financial markets seem to be confident that there won't be a lot of inflation. Now that could be because nobody thinks there's ever going to be a recovery, or it could be because people think there's going to be a recovery and the Fed will handle the exit strategy satisfactorily. And I think the Bank of England issues here would be analogous. I think the most likely source of the next kind of crisis is what I call crises of governments, and I think there's a lot of fragility in this respect. A good deal of it has to do with the longer-term lack of fiscal discipline, which has become more apparent recently, especially for some European governments, but also for U.S. states. Those are where these issues have become most clear. So I think deriving from the lack of fiscal discipline is a serious threat, I would say, to the maintenance of the Eurozone as it's been constructed. This, of course, is about the crisis in Greece, Portugal, Ireland. It'll be more serious if it spreads to Spain because Spain is much larger, and that's really going to be a source of acute danger for this institution. Now, I think that the euro should have been just a currency zone. And I think as a common currency, it made a lot of sense. And when I spent a year in England in 1995, big issue was whether the UK should join the euro. That was very contentious at the time. My view at the time was for a common currency all by itself, it would be a good idea for the UK. But that in fact, you couldn't join this without getting a lot of other baggage. And the other baggage was that it was a semi-fiscal and political union. And the UK, I think, didn't want either of those things. And in retrospect, of course, I think now the UK is very happy that it stayed out of this arrangement. So I don't understand the argument people have sometimes made that if you're going to have a common currency, you have to have a fiscal union and maybe some kind of political union. I don't know the evidence that supports that, and conceptually it doesn't make sense to me. So another way to put it If Greece wants to issue bonds denominated in euros, that's fine. But that shouldn't be the business of the other countries and governments to prop up those bonds in terms of guaranteeing their repayment. That's the part of it that's troublesome. And of course, if Greece is in a situation where Germany is going to bail it out all the time, there's not enough incentive for fiscal discipline, and it's the lack of that discipline that's the source of the crisis itself. Now, there's a lot of parallel in terms of the situation of some U.S. states. It's very analogous, I think, to the euro problems. The problem for U.S. states is not so much that there's too much formal government bonds. It's other kinds of implicit promises and sometimes explicit ones that the state governments have made, particularly in terms of overly generous pensions and health care benefits. And that's what's going to bankrupt a lot of the U.S. states, ultimately. They've made promises that seem to be fiscally impossible in many circumstances to actually follow up on. So I don't know what's going to happen in the end there. I mean, if Illinois decides, I was only kidding when I said you could have these pensions forever and they're too big, I don't know what the U.S. government is going to do in response to that. Is that going to trigger some kind of default? Is the U.S. government going to bail that out? Is the U.S. government going to say that state governments are too big to fail, which again I thought was true for Lehman but not for General Motors? So I'm not sure how this is going to work out, but it's not so different from the euro problems. So I think there's a need for some basic fiscal reforms, which I think is not a controversial statement. So a lot of that is in terms of curtailing government expenditures. And you have to keep in mind that there was a vast expansion in the U.S. of various government programs, both under Bush and Obama. So part of this is just getting back to where we were in 2000. But then there's also this longer-term structural problem related to the major entitlement programs, particularly Social Security, pensions, and the medical programs. So that's going to be a major burden, which would have been there even in the absence of this crisis. I think there are some major tax reforms that could be part of this package. So for example, if you let me do whatever I wanted, I would get rid of the corporate income tax in the United States. That form of taxation makes no sense, and it doesn't raise very much money. I wouldn't have an inheritance tax. You would need some kind of more revenues. You can get some of that by cutting back on these so-called tax expenditure items, which are deductions in the income tax. But the bigger question in the U.S. is whether to have a value-added tax, which is one of the favorites in Western Europe. So the value-added tax, I think, overall is this brilliantly efficient form of taxation, which is both the plus and the minus of this system. So more or less like the payroll tax in the U.S., the VAT is very good at raising a lot of revenue. So that's good because it's not so distorting to raise the revenue. It's bad because when government has available this kind of money machine, it tends to grow larger and spend more. That's the key trade-off in terms of efficient taxation and whether you want it or not. But in the U.S., I don't really see an alternative because I think given the status of the entitlement programs and where they're going, I think the U.S. is going to have more revenue, and I don't see an alternative to this to this form of taxation. So I think this is coming at some point. Larry Summers had a famous statement here about why we didn't have a value-added tax in the United States. He said it was because the Democrats thought it was regressive, and the Republicans thought it was a money machine. And sort of the consensus between those two prevented it from being enacted. And then he followed it up by saying, you know, we're going to have a VAT in the U.S. when the Democrats realize that it's a money machine and the Republicans realize that it's regressive. This is from Summers. There's pluses and minuses of this program, but I think it's coming. I think the U.S. is the only OECD country that actually doesn't have this system. I just wanted to finish up by my outlook with respect to this double-dip recession chance. Things looked a little better 6 months ago or so. And I think Obama did his best economic intervention really in December 2010, which was preserving the tax rate structure for about a week, not saying that you had to tax the rich at a higher rate basically because they're bad people. He actually did have a tax rate cut as part of the package, as I mentioned. It was the Social Security tax rate that was cut, effective at the beginning of 2011. I thought that was a positive development relative to what had occurred. But there are various indicators that look quite weak with respect to the recovery in the US, and that's true for GDP growth. It's true for the labor market, particularly the sustained high unemployment rate. It's true in terms of house prices, which really are not recovering. It's true in terms of the stock market, which having done pretty well for a while, then turned downward. And it's true in terms of the underlying fiscal issues not yet have been seriously dealt with. You do hear some voices in the US that I think are more rational than usual, but it's not clear at this point how it's going to work out on net in terms of solving the basic fiscal problems that are there. There are also these questions about future inflation, which I've discussed a bit. Again, the financial markets seem to be quite optimistic in that regard. And then there's this broader question about potential default on government obligations, which is part of this crisis of government. That's somewhat more acute in Europe, and it's a little hard to see how this is going to be escaped. But the US states, again, are another source of concern about this problem. So on net, I don't end up being terribly optimistic at this stage, and I'm sorry to have to end on this downward note. Thank you. Here?
Do you want to answer questions from here?
Yeah, that's fine.
That's good. Okay, well now we've got time for about 15 minutes of questions, after which there will be a reception, I think at the back, maybe in another room as well. We've got 2 roving microphones, I think, downstairs, and 1 upstairs in the gallery, which I'll direct to people who want to ask questions. When the microphone reaches you, please give your name before asking your question. And may I just say that, as usual, we'd like questions, not comments, please, and fairly short questions rather than very long ones. Gentleman there.
Quentin Langley. If banks are too big to fail, should they be broken up? And if so, now or later?
You know, I think this is part of the more general question about what kind of regulatory changes you would want that particularly relate to financial institutions. One consequence of the crisis was there's been a tremendous outpouring of research on that question in terms of, why did you have this financial implosion? What kind of regulations seem to improve matters? I think some of the capital requirements coming out of the BIS are sensible in terms of, which is basically increasing the capital requirements. And sometimes it's proposed to do that in a progressive manner, which is discouraging financial institutions from growing too large. It's puzzling about the too big to fail thing, because on the one hand, you get these institutions that are in that status, and then the government feels, I think accurately, that ex post it has to bail them out. But on the other hand, if you look at what did the government rely on in terms of solving some of these problems, at least temporarily, it relied on very large institutions, like J.P. Morgan, for example, taking over Bear Stearns or something analogous to that. So I think there are regulatory changes that have been proposed that could make the system work more effectively. Now, whether one predicts that governments will actually move in a direction where, on average, the changes in regulations are favorable, I would not be too optimistic about that, because they're probably more likely to make changes that will make things worse than to make them better.
Yes, down here at the front. The microphone's just going to meet you.
Thank you. Rupert Fast. If injecting more money into the economy, quantitative easing, doesn't cause inflation, what do you make of the rampant inflation people are experiencing in the UK when incomes are barely rising at all? And is there a risk that this will turn us into a second world country?
I started from the proposition that if you just told me that, for example, in the United States, that the Federal Reserve had suddenly expanded high-powered money by $2 trillion, that I would have said that that would be very inflationary, and that would be the normal kind of response. Now, from that perspective, in the US, for example, the inflation rate has ticked up a little bit, but not that much. I don't know why you say rubbish. I mean, you think that statistics are unreliable?
Okay, thank you.
There have been other developments in the world related to commodity prices and related to food prices, and indeed the ethanol program is part of the rationale for why food prices have increased so much. So some prices, of course, have gone up, but I don't really have a problem in believing that the overall index of prices, for example, the consumer price index in the United States, is reasonably reliable. And you've seen a bit of an uptick in inflation, but not very much. And as I mentioned, in terms of expectations in the financial markets, it's not for a lot of inflation in the future. That's also true in the UK. It's similar to pattern in terms of if you look at expectations over the next 10 years for retail price inflation in the United States, in the United Kingdom, it's not high. So the belief there is that there's been a temporary blip in inflation related to certain prices, for example, but not that it's an endemic thing. So you put that along with the quantitative easing, and you would have thought that that would be inflationary. So I was trying to interpret why I thought it had not been more inflationary than it has been, and it hasn't been all that inflationary. And I was trying to give an explanation for that. But again, the nature of the exit strategy is crucial in terms of the longer-term implications.
Of course, you might also remember that the most damaging kind of inflation is precisely the unanticipated inflation. Question down here. Yes, at the front, very front.
Matthew Sinclair from the Taxpayers Alliance. To what extent do you think China's likely to continue to perform strongly, or is likely to suffer a hard landing as a result of what appears to be an asset boom there?
You know, overall, I'm optimistic about the China experiment, which really goes back to roughly 1979, when they decided to become a market economy to some extent, you know, relative to the previous. There's a lot of potential there for further convergence toward the richer states in the world. So they're only about 1/7, for example, the per capita GDP of the US today. So even though they've been growing for more than 20 years, almost 30 years at quite a high rate, there's still quite a bit of potential in terms of this convergence. There are a number of potential pitfalls for China, which I have thought about for some time, being something different from what you proposed. I think the two major pitfalls are, first off, on the political side. What's the nature of the political liberalization which usually has to come when countries get more prosperous? How are they going to move towards something that looks more like democracy, more civil liberties? Is that transition going to involve some kind of violence, which it could have done in 1989, but it, of course, there was a different outcome at that point. Secondly, there's this tremendous rural-urban divide, so a lot of the growth has been focused in the urban areas, and that produces a lot of other tensions related to internal mobility. So I would have focused on those factors rather than, per se, the asset boom or the big infrastructure investment boom that the Chinese government has initiated. I have less concern about that than about these other 2 points that I mentioned.
Okay, lady there, and then the gentleman up in the gallery.
Thanks. Linda Whetstone, you ended up on a pessimistic note. You obviously know a huge amount about these things, but you didn't make suggestions, for instance, you know, what should the US and UK governments be doing to, for instance, to get out of, to make it more optimistic in a year or two's time?
Well, if I go back to 2009 in the US, for example, I think it's quite appropriate to have a fiscal deficit in response to a large recession. I would have focused all the response on the tax side. I wouldn't have been doing a lot of expenditure programs that don't seem to have any rationale intrinsically because they're not really productive kind of public sector activities. I would have focused it all on the tax side, and on the tax side I would have focused it on things that have incentive effects, which means that you want to cut tax rates, not just throw money at people. So I think I could be able to come up with a pretty good concrete program for what that tax reform package would have looked like. And I'd still want to go forward in that direction. So I wouldn't be doing the expenditure programs. As I mentioned, I thought a lot of the financial sector bailouts were unavoidable, and I wasn't really criticizing that part of the response, which occurred starting in 2008, going into 2009.
Economic historian. I hope Keynes did not use Germany for his general theory in 1936. Not everyone, even today, knows that Germany had the money to reflate her economy in 1933. She was the world's greatest exporter in 1931 in terms of value. She also had 40% cover for her banknotes in the Reichsbank. She used deflation for political ends in the Great Depression. Germany's not the same country as she was then, but can we reflate our economy when she's still in deflationary, Europe is in deflationary mode?
So, you know, I've done this study of rare macroeconomic disaster events using lots of countries over periods that are longer than 100 years in terms of the data. So Germany is an interesting case there because it kind of experienced all the bad events in the period involving and between the two world wars. So it has like 4 macro disaster events in the period between 1913 and 1948, including the 2 world wars, but also the Depression, and then it had its own hyperinflation, which was associated with the aftermath from World War I. So Germany has been a quite interesting case from that perspective. I mean, Keynes actually started doing work that was maybe more serious, which was about hyperinflation and about government revenue from printing money, and a lot of that was applicable to the extreme inflation period of Germany. I think it's true that after the hyperinflation that Germany was more sensitive to that issue than most other countries, and that's why Germany would have a tendency toward deflation and also toward price stability, which I think is a characteristic that's still there. So people think that that has to do with the history of the hyperinflation in the early 1920s. I'm not sure how correct that is.
Okay, gentleman here, and then up here in the gallery.
Nigel Vinson. Can I come back to infrastructure development? The infrastructure in this country is almost third world. People come to go potholing here. Wouldn't it be sensible to, you mentioned earlier, put contracyclical finance into our declining infrastructure, where it undoubtedly would yield economic benefits and also have a much higher multiplier effect, probably even up to 2 or 3?
You know, I'm not basically an anarchist. I don't think that there's nothing governments can do that are useful. And filling potholes is probably one of the most useful activities that governments undertake, and it's always a shame they don't do more, and I certainly see that in my own locality as well as in the... So I'm not disputing the idea that there might be useful social investments of that type. I mean, it would be a matter of looking at the particulars if you're talking about a particular airport, a particular highway and such, and I'm not saying that those are bad ideas in general. I don't think they become so much better ideas during a time of recession than they are in other times. And it's a question of getting the social rate of return that makes it worthwhile to put the resources into those activities. Otherwise, if you're just trying to expand the economy because you think there's a downturn, as I mentioned, I think you should focus that on the tax side in terms of where the fiscal deficits are, and particularly on tax rates. So I don't find that a justification for public expenditures that are not worthwhile in terms of the social rate of return per se. So that doesn't exclude airports and highways, but I don't know that you particularly want to do it in bad economic times. So Japan is the real example of this. It's really been 2 decades or so. Japan used to be a low public debt economy, and they've had a vast expansion of public sector borrowing, and a lot of it to finance all sorts of infrastructure activities. And it never really helped in terms of the economic growth of Japan, which has been quite weak for some time. But interestingly, every time they did it, every time they had some kind of infrastructure investment boom, and it didn't seem to help the economic growth. The response from some economists was that they didn't do enough. And that's the same in the US fiscal stimulus package. We did this program, which was like $800 billion, and the results looked disappointing. I think everybody agrees they look disappointing. I take that as some indication, well, maybe we shouldn't have done that. But the response from a lot of Keynesian economists is that you didn't do enough. So my great friend Paul Krugman always has that viewpoint, for example. We just didn't go far enough. We didn't stick with it long enough. But then you never seem to get the answer that, well, maybe this wasn't such a good device for curing a recession in terms of governments expanding their expenditure on various activities. Of course, it's also true, and I don't think this is really controversial, that most of the fiscal stimulus stuff in the US was not on these kinds of social expenditures that you're suggesting are productive. That really is not what it was composed of. And somebody gave me this good line yesterday saying it was basically shovel-ready stuff, but anything that's shovel-ready must not be very productive in terms of social rates of return. There must be something funny about it. If you can all of a sudden spend all this money in a quick way, it must mean that it's not really a high rate of return from a social perspective. So anyway, those are my thoughts.
Gentleman up there, and then gentleman in the front row here. I'm afraid that'll have to be all we have time for.
Thank you, Michael Lyon. I'm afraid the gentleman just asked more or less the question I had in mind, but perhaps I could just develop it slightly, which is to say that I think what perhaps is being groped for is a smarter approach to government expenditure fiscal response, rather than the somewhat crude response that we're taught from Keynes and the holes in the roads. Do you think that there might be scope for economists to develop the thinking on that? For example, it would require things such as medium-term tax balance, criteria on the selection of investment projects, and so forth.
So the problem is, if you really think the spending multiplier is around 2, which, for example, the US government subscribes to, then you basically just want to do a lot of it. And, you know, it's better to do something productive than non-productive, but it's not that critical. So I think sort of getting that magnitude right, or approximately right, or something reasonable is central to thinking about this kind of fiscal response on the expenditure side. So I think that the US government really believed that the multiplier is something like 2. And I think that explains a lot of the nature of the response. On the tax side, I think there are a lot of good proposals for how you can make the tax system more productive, particularly in the United States. And I think a lot of that makes sense. And I think there are some good reforms that could be made there that would promote economic growth over the medium term and longer term.
Okay, last question down here, please.
Graham Leach, Institute of Directors. Robert, in what circumstances can you achieve an expansionary fiscal contraction? How do you get a negative multiplier?
You know, I take that question seriously, and I've sort of been trying on my own research agenda, and I mentioned other people's research, to try to get a better idea on exactly that kind of response. For example, if you think about transfer payments, is it right that when the government borrows more money and gives it to people, maybe unemployed people, does that have a positive effect on GDP? Is that expansionary? I don't know any empirical evidence on that, but a lot of macroeconomists believe that that's true, and therefore they believe in reverse, that when you have the contraction, it's going to be contractionary for the economy. But I say I don't know empirical evidence on that. I think accumulated some evidence about what is the response of the economy when the government is doing more activities that look like purchases of goods and services. And that was where I got this spending multiplier of around 1/2, which came from some particular kinds of evidence, which we could debate about, but at least it came from somewhere. And I understand some of the magnitudes involving tax changes and what is the response of the economy. But in terms of some of these other magnitudes, people argue as if they sort of know the answers to these things, and I think it comes from basically nowhere. So it would be a good product of this current, out of this current global Great Recession, if, as I think was suggested sometime before, if you had all these different responses from different countries, some with these more contractionary policies and some with these perhaps extravagant expansions, and then we could look at what was the answer for that. Now, from an economist's point of view, what you really want is that the governments are doing this randomly. You know, randomly you say, well, okay, Germany, you have to be conscientious and tough. Greece, you do the opposite. You want the assignment to be unrelated to what the economic structure was and the economic outcomes. And the problem is that's not exactly the way the data come. But maybe somebody can be clever enough to use the results of this episode, 2008 to 2011 or so, and evaluate the different responses and give us better answers for some of those questions, not all of which do I think I have the answers to.
Good. Well, I'm afraid that's all the time we have for questions. So I'd now like to ask Michael Hinsey, a trustee of the IEA and the chief executive of CQS Management, who sponsored this evening's event, to propose the vote of thanks.
Indeed. Thank you so much, David. And most importantly, thank you very much, Professor Barro. It's been an enlightening and provocative speech. Now, to be clear, this does not happen by accident. It's as a function of the very good work of various staff of the IEA, such as Philip Booth, Mark Littlewood, and of course the other broad-ranging efforts that are being done here. There's a huge importance in our current world to have debate, to have a proper dialogue. And frankly, I must admit, where we've gone this evening reflects your wide-ranging experience and your wide-ranging research, and for that matter, your wide-ranging intellect. And to that end, I would like to propose a vote of thanks, and in a regular way, let's do so.